Hello, I'm Natasha Brook-Walters, co-head of iStrat, Wellington Management's Investment Strategy and Solutions Group. As we ring in the new year, we're taking a moment to ask, where should investors focus in 2023? We believe 3 objectives should be near the top of the list: mitigating downside risk, planning for cyclical uncertainty and macro volatility, and positioning portfolios for the new long-term economic realities. In the last 20 years, the traditional 60-40 equity bond portfolio has been sufficiently diversified to help investors weather different market environments. But this past year, with structurally higher inflation and rising interest rates, both equity and bond markets declined, challenging this risk-mitigating relationship. So we want to emphasize the importance of looking for downside mitigation in different places. For example, within macro strategies and other defensive hedge fund styles, or defensive equity strategies. Going forward, we should expect a more volatile economic cycle. We should also anticipate greater cyclical divergence between countries as policymakers make different choices about growth and inflation. This will lead to higher volatility among assets like rates and currencies. For investors who wish to reduce exposure to the economic cycle, our research suggests that returns from thematic investments are less reliant on the current state of the economy. The shifts to higher inflation, interest rates, and volatility are most likely structural, not cyclical. They represent a new economic reality. So in 2023, investors must ask themselves how their portfolios will need to evolve. One solution could be to put a source-driven inflation strategy into place. This involves choosing hedges based on the specific factors driving inflation. Another could be to invest in secular trends, like financial inclusion or innovations such as electric vehicles. And of course, finally, making sure your portfolios have a more balanced factor footprint to help manage the risks around the volatility. The bottom line is that times are changing and portfolios will need to change with them. Given this environment, active management has never been more important. Thank you, and I hope you find these iStrat insights from the team helpful as you plan for the coming year.